John, so good to see you. I want to dive right into the headlines. It's been a wild ride. We're talking about markets and geopolitics. So, rising tensions in Iran have pushed oil prices higher and created short term volatility in the markets. Historically, however, geopolitical conflicts tend to have only a temporary impact on stocks. As we record this right now in mid-April, I do want to take a look at the 3-month performance of the S&P. We see a lot of colors on the board here, John, but the question is, why do we tend to see stocks fall first when tensions rise?
Well, the market doesn't like uncertainty.
Mm.
And a lot of the market also is based on retail fear and greed, right? That's an emotion that we've talked about a lot. So to make this answer short and sweet, the markets don't like the uncertainty of how long this war is going to, last. What are going to be the ramifications? Obviously, with the Iran conflict, the Strait of Hormuz, that plays a huge role. And, what are going to be the lasting effects, right? Are we going to start as this conflict is, entering a couple months in, what are going to be the trickle down effects to the consumer? All that unpredictability leads to volatility. And then, of course, we hear, things that we may not agree with on the media or that sparks some type of emotional fear. And then the retailers sell off. So unpredictability is the name of the game there.
Yeah, certainly feels that way these days. So on the other hand, though, history does show the S&P usually recovers quickly from geopolitical events. I know you love your data. I know you are a student of history, John. And so we see here several events and mostly short, shallow pullbacks. What are we looking at?
Well, we're looking at the fact that, as soon as people, realize, like, go back to the 90s, that Desert Storm was going to be a fairly easy conflict, then they feel comfortable about it. I think, the big events, like, when we have, Pearl Harbor or whatnot, that is more of a blacker swan event that has a more lasting impact. But if once people get a good gauge of what's going on with the conflict, I think they feel a little bit more comfortable in the direction of the markets. Now the challenge with this market is, we just have so much back and forth. One day we're at peace, the next day, we're gonna obliterate. So that is really what I think is causing a lot of the volatility. But as we're recording this, we're now in the peace stage, and the market is starting to soar up more.
Right. Yeah. Which is why we have to tell everybody we're recording mid-April, because who knows what things will be a week from now. But
who knows what it'll be tomorrow, really?
Yeah, exactly. On that note, for investors, John, who are watching all of these crazy headlines and rising oil prices, what's the most important perspective we should keep in mind before making portfolio decisions?
Yeah, well, never, ever make a portfolio decision based on emotion. And really, I'm going to speak to two types of investor. There's the buy and hold investor, right? We've talked about this in the past. This is the industry standard. You have a good idea of what your portfolio should do in good markets and bad markets. You just stick with that. You don't make your move. Now, we do things a little bit different in our practice. We're more tactical. So we look at what the institutions and how the price action and all these technicals are moving. And Aaron, if you do me a favor, pull up the S&P 500 chart. You're going to see that we're actually making moves and we're keeping our clients informed. So back even before this conflict really started getting ramped up in February, we started to see weakness. We started to have the government shutdown, and we started to reduce equity positions when we started to see multiple technical signals that you're looking at this chart fire off. And March was a positive month when the S&P 500 dropped. So that wasn't emotional driven. That was data driven. So we're a little bit different, but it's really important for me as an advisor to communicate to our clients what we're doing, because when the Strait of Hormuz got shut down, Aaron, we were in BNO, which is, Brent crude oil. And then we started seeing volatility swings, and we'd made the decision that let's not have the greed Let's take our profits and move off. So again, my point is you have to understand what you're going to do and have a plan before chaos hits. And if that is buy and hold, like probably the majority of the people watching this video, you just have to understand or talk to your advisor. Hey, I know you don't know what the market's going to do. Nobody does. But what is my, can you just refresh what is my downside risk here, during this volatile time? And
Right.
and
On that note,
I will say one last thing, Aaron, on this is people don't understand that it's just not headlines. And you pulled up a chart there, and I want to refer back to it because this is where I was going. It's not just the S&P 500. You need to be tracking two other things. If you're tactically managing a portfolio, you have to understand what high yield corporate bonds are doing, because those often lead. If you look to the left of the state of the screen, when you saw that big drop down, that was right around the same time that the S&P 500 dropped down last March and April. The third factor you have to look at is U.S. government bonds. This is not what you want to see. You don't want to see government bonds starting to go up to 5%. That could really stress things out. A lot of people say that, a lot of analysts believe that Trump is very aware of this. And when, he tends to have good news when this starts getting up to 4.6 or so, because he does not want this to get near 5, because that could really trigger a sell-off. And the closing point to this is, if you're trying to navigate this market, I follow several champion investors, and a couple of them have had the blogs that, over the last couple months, if you're playing this market, you have to realize you're playing in that expert mode. So it's a very tough market, a lot of swings, and so you just have to have that game plan.
Right. And like you said, you are making decisions based on history, based on data, not based on the headlines and how they make us feel. Can you just talk me through how emotional investing tends to lead to bad financial decisions?
I mean, on both ends. And I saw this a lot, even in the buy and hold, when our portfolios were still doing better than our competitions. People have FOMO and people have fear, the fear of missing out, and then the fear of losing money. And, when the markets are up 30%, they want to try to get as close to 30% as possible. And in my office, I use poker chips. And I tell people, listen, if you're in Vegas and you're at a blackjack table, what table do you belong at? Do you belong at the $5 table, the dollar table, the $50 table? And if you're a $5 blackjack player, are you going to start getting swayed? Are your emotions going to start getting swayed if other people at the table are winning $50 and $100 hands at a time? And overwhelmingly, and I tell people, be honest, they say yes. And that's the same thing with the market. And we've kind of talked about market manipulation and whatnot in the past. Just I ask people, why do we have to have the Dow Jones, the S&P 500, and the NASDAQ, on our news channels right there in the corner 24/7? Right? That may, in the tin hat world, kind of be a manipulation to drive that fear and greed. And people, when they start seeing that red, and they start hearing, the market had a huge sell-off today, then they check theirs and they start to see that real money is flowing out of their account. They make those bad decisions. And this is just not John saying this. This is, 30 years plus of data from Dalbar that's saying that people do not follow old Grandpa Buffett's advice of buy low, sell high. They may have bought low and rode it up, but then they sell out at the very, near the bottom. And then once they've experienced that, it takes them a long time to get back to that confidence to buy. And, oftentimes you start to see that buy-in is closer to the top where, we've talked about this before. That's the point of maximum financial risk.
Right. Yeah. I'm so glad we get to talk this through, John, because it does, really differentiate between people who have a plan and people who are just leading with emotion, which is hard not to do as a human. So if somebody wants to come to you and talk through putting together a foundational financial plan that's in line with their risk tolerance, what's the best way to reach you?
Yeah, visit our website, www.gosecurus.com. While you're on the website, we have tons of videos in the past that talk about, the fear and greed
Mm-hmm.
and how important of a role that plays. And Aaron, you mentioned it. I mean, it drives everybody. It even drives advisors. It drives me. If you say you don't have emotions when it comes to money, then you're an incredible person. But again, like you say, we use the data to overcome our emotions
Yes.
and to really keep in check. And that was a big key part that I want to, our clients knew that if things got really bad, they kind of knew their end game because we were at a position of safety in March.
Mm-hmm.
So
Mm-hmm.
we have videos on fear and greed. And while you're on the website, if you do want to talk with us, you can go head over to the Contact Us tab where you can schedule a 20-minute phone call where I will answer any general questions you may have. Or if you want to elicit our services, go ahead and click on the Vision and Clarity consultation, and we'll get you set up.
Great. John, thanks so much for your time today. I appreciate it.
Thank you, Aaron.